Good morning, I'm Jeremy Glazer. We're seeing further carnage in the equity markets today, and I'm here with Bob Johnson, our Director of Economic Analysis, for a look at some of the data that could be underlying the weakness. Bob, thanks for joining me.
Great to be here today.
So let's talk about what's driving this most recent fall in equity prices. Is this just continued worries over China, worries over oil falling below $28 a barrel? What do you think the proximate cause is here?
I think that we always have to be careful when we do this because markets are very complex and many factors go into them. But I do believe that China may be at the root again of today's weakness. We started out the week with their GDP numbers, which showed the slowest growth in many years in the high 6% range. And actually, there was some initial relief that the numbers, weren't worse and that there wasn't some big number and we didn't have a disappointment. And there was some positive reaction to that yesterday. And then today, I think it kind of sunk in, well, even though these numbers weren't so great, the government really didn't do anything about it. They didn't lower interest rates or change borrowing percentages or do anything to kind of really support markets, if you will. And I think that lack of support, I think everybody had thought, well, okay, we'll get the number that's kind of mediocre, and then they'll kind of go announce something and we'll all be happy. And I think that we didn't get that extra fillip of stimulus from the Chinese government. And I think that's what got things started. And we had the Asian markets down first thing in the morning their time. And certainly it followed through to Europe. And we already knew in pre-market the U.S. Was down a lot. So I would say that was probably the biggest proximate cause. I think that certainly deflation reports, which came later out of the U.S. and out of Europe, both seem to indicate that maybe deflation was a little bit bigger problem than maybe some people thought. And then we certainly had compounding that IBM earnings. Certainly I saw a lot of other companies like Netflix that looked a little better, but certainly IBM's a much larger company, a much larger employer, and that certainly didn't help matters where everybody was already a little bit nervous, and certainly raises broader fears about corporate earnings.
So now one of the big questions throughout the sell-off and in the sell-off this summer has been, are China's problems contained to China, or are they going to spill over to other emerging markets or into the U.S. or other developed markets? What kind of data have we seen from the U.S. To show if the economy is holding up or if it's starting to feel the impact? There was a somewhat disappointing, at least on its face, retail sales report last week.
Yeah, I mean, again, things get complicated there if you look some of the quarter-to-quarter volatility. And we caution there's so much inventory and odd numbers in some of the quarterly numbers. You do have to be a little careful there. But anybody that wants to put a negative spin on it, it certainly looks like growth in the fourth quarter will be well below what it was in the third quarter, and that kind of sunk in a little bit more last week. And we may now be lucky to get 1% GDP growth in the fourth quarter, which of course will fit in, well, China's slowing and it's influencing us or whatever. But again, that's not what's really driving the U.S. economic number down. It's more to deal with inventories in our very warm weather that we've had, which has driven utility usage and apparel both through the floor. And when you're dealing with seasonally adjusted, very short-term numbers that you have to end up multiplying by 4, those problems all kind of get exaggerated in the statistics. But certainly there is some realization here that growth in the U.S. will be slower, but it's not a result of China. If anything, I think import-export data is likely to be kind of net neutral on the fourth quarter GDP report. So certainly China is not having any direct impact on that. So, and I would say, remember that some of the time when China was the strongest weren't the best days for the U.S. and especially Europe. And now that they're a little weaker, certainly Europe has been getting stronger weekly recently, even in the face of slowing China in terms of their GDP report. So I think that's kind of an interesting phenomenon. I really don't think that China has spilled over as much as people are giving them credit for right now. Will it affect other emerging markets? That might be the broader impact. And anybody that sells them commodities, which are many emerging markets related companies, that is a bigger issue.
You mentioned that one of the compounding factors today were some of the inflation reports out of the U.S. and Europe. When you look at U.S. inflation, anything in that report that kind of changes your thesis on what's happening with the U.S. economy?
It was a little bit more of the same, with maybe a little bit more whiff of deflation. I mean, I think the minus 1/10, that we actually had a 10th deflation month to month, was kind of relatively in line. You did the rounding, maybe it was a little worse deflation or a little bigger deflation number than people expected. Certainly, the deflation in this report looked much broader based in terms of goods. It was hard to find a goods category that was up at all. So certainly that was worse. And meanwhile, on the other hand, services inflation remained relatively high at about 2.9% on a year-over-year